Shakkottai, along with Recon Capital CIO Kevin Kelly. Good to see you guys. Reva, where's this market going?
I think the last week it's been a little bit of too much too quickly. We're rallying this week on the back of a jobs report, which was really a mean reversion. We had a bad print in May, so it made the June report look stronger than it really is. So it's possible that we're going to retrace half the distance on the Dow back to 17,000, and same with the S&P back to 2,000.
Okay, so you think this is overblown right now?
Well, I do think it's gone too quickly. That being said, over the next year, I am bullish on the markets.
How bullish?
I think that the Dow's going to get to 20,000. I was on this program 9 months ago. I said Dow 18,000. Everyone laughed at me.
No, you're right.
How do you like me now?
So 1,500 more points between now and the end of the year?
Yeah, I would say that we're going to hit Dow 20,000 before we ever touch Dow 15,000.
Okay, but you're worried about the interim. In other words, this summer could be tough.
I think there's going to be some better buying opportunities coming up in the next couple of weeks and months.
I don't know, though. I mean, you got a market. We've got basically some of the Brexit concerns out of the way for the most part. You got the Fed unable to do a darn thing, Kevin. So, you know, if we continue on in this sort of slow growth environment, but, you know, with the spigot still on from Janet Yellen and company, shouldn't that drive us higher?
Well, what you should look at in this market is what's really driven it. And one of the main things that drove it from our February lows was the dollar. The dollar got a lot weaker, commodities started rebounding, and that stabilized the market. Now here we are again. The dollar's getting stronger, and guess what's happening? Corporations are going to start giving earnings guidance going into the future, and now that the dollar's stronger, it's going to be hard. Yeah, here's the best way to invest in this market right now. Okay, we see we're making highs. What do? You find companies that have enough cash on their balance sheet to increase their dividends, do M&A, mergers and acquisitions, as well as continue their share buybacks. There's only one sector that I can find that can do it, and that's the technology sector. Otherwise, these companies are hampered.
Would you recommend, given the dollar issue, that people try and stay local? In other words, be domestic?
Yeah, here's the problem with that. The market has already moved there. If we look at Under Armour, Under Armour is a great company, right, in the discretionary. Yeah, right, exactly, but they're trading at a high multiple, and they have 90% of their revenues are domestic, and they're trying to expand overseas, but now that the dollar is stronger, it's going to hurt them. And so that's what's happened. Domestic, look at utilities, 30 times earnings, and they've got a big dividend yield. You could go to 21 times earnings in tech, and you're getting a 1.8% dividend yield.
Okay, so for an investor that is in for some long-term gains and maybe is willing to ride out a rocky summer, which you seem to think it will be, this is a good time to get in? Or no, just wait a couple weeks?
I think it's good to keep some cash on the sidelines because I think there's going to be better buying opportunities. I don't think the volatility that we've seen in Europe is over at this point. And we are coming across earnings season. I mean, we've only had 50 companies report. The real fun begins next week when the industrials and technology and the staples start to report. So then we'll get a real good glimpse of what's happening in earnings. Okay,
and meanwhile, what does the Fed do in this environment, Kevin?
Oh, the Fed's going
to an election season.
Listen, the one thing you need to look at is the yield curve. Completely flat. We're seeing $11.7 trillion in negative yields globally. The Fed is not going to make a move this year, and they'd be hard-pressed to do it next year.
And this is why I think your 20,000 call could be right, because people are going to be forced to keep putting their money in the stock market because they don't have a choice. You can't buy treasuries.
Well,
you're going to want those dividend yields.
Yeah, here's the problem. Until, going back to what I said earlier, those companies don't have enough cash to reinvest. Because what did they do? They did a lot of buybacks. So they're going to need to continue to cost cut. That's what the banks are going to do right now.
Look, we've been, unfortunately, showing how good we are as a nation at all this cost cutting.
Correct.
And it's costing a lot of people their jobs. And, of course, you got to wonder, at what point does that really start to send the economy south? Good to see you guys. Good to have you here in the house, Reva. Last time I think you were in L.A. Good to see you, Kevin.
Thanks.
We're going to be right back with more right after this.